Hey guys, it's Austin and Jeanette, and if you're new here, consider subscribing.
In this video, we're going to teach you all about insurance, all the different kinds, what they mean, and how to get the best rates.
Coming up.
Happy Monday!
How's it going, guys?
We are so excited to be here with you tonight, and we've got some great things to talk to you about. So, tonight is about insurance.
It's my favorite topic. It's her not favorite topic.
Well, because it was so confusing, right? Because, especially as a kid, you're 16, 17, they're talking about you need a health insurance plan, a PPO, an HMO, or you need a whole life or term life insurance. I'm like, I don't know what any of this means, or what am I supposed to choose?
Yeah, there's a lot of things that go along with it. And in terms of, you have to, understand, I have to deal with, the thought of me dying and stuff like that. So
I don't care about that.
You really have to, I don't know, just be an adult.
Yeah, and I was not an adult, and I still am only barely an adult. So, this is what we're going to talk about today. So, the first thing we're going to talk about, so we're going to go through a couple of them, right? So, let me just give you the list, and then we'll dive right in. So, it's going to be insurances, life, home and renters, auto, health, disability, long-term care, and identity theft. And then all the stuff that you should just never, ever get. And then this is also all in the newsletter that we sent out this morning. So you can pull that up and go right along with us if you want.
Yep, so the first one we're going to dive into is life insurance. So a lot of people, I've seen people just go insure their phone but don't have life insurance policies in place and things like that.
Whack.
Right? So the biggest thing is people don't understand which one to get, and that allows them to fall prey to predatory insurance agents who just want you to have whole life or cash value plans. And I'm not saying that's a horrible choice. I'm just saying we teach to defer to term policies, and we'll go into that.
Yes. So what is insurance in the first place, right? Insurance is something that transfers risk, right? I've got a risk of death, and when I die, I want my family to be taken care of.
Right.
So I'm giving that risk to somebody else.
So insurance is just a transfer of risk. And the more risk you can transfer, the more wealth you can build.
Right. So if I can insure X, Y, and Z, then I don't have to worry about it because I'm paying somebody else to worry about it. But also, you got to be careful on what things you actually want to worry about and what things you want to pay somebody to worry about. And then all the details on what your policy includes, how much liability you have, blah, blah, blah. We'll go into that.
And there's a lot of noise in the system, which allows people to be all confused about what kind of policies they have.
Me.
And what kind of things they're actually covered for.
Me.
So
those are confusing.
Let's dive into whole life or cash value. So whole life or cash value, we teach people to stay away from because one, it tries to do too many things at once. So they bundle it as an investment or a savings plan that pays out when you die. But the kicker is, majority of the time, these plans actually lose value as you mature in age. They actually, their payout is less. Or if you die, your beneficiaries, the savings account portion of it doesn't get paid out.
It just disappears.
Right? Your family does get your policy amount, but the savings account part goes right back into the insurance company. So we teach people to stay away from these ones because the purpose of life insurance is to transfer the risk of your family not having money if you die.
That income that's lost once you die. So that's and burial expenses. Those are two things that it needs to do. Help with funding after you die because your income is no longer there. Or burial expenses.
So you really just need it up until the age of retirement, right? Because if you're generating $100,000 a year in income, you'd want to replace that if your family still needed that to sustain their living standards until, normally retirement is when you don't need to maintain those things anymore because you have enough cash built up and you have enough to self-insure.
Okay.
So
yeah, we'll talk about self-insure after we talk about term. So then another thing is whole life policies. It's hard to change those, right? Because sometimes it's better to have something than nothing. And an agent is they make the most money when they sell you a whole life. So be careful when you go to these agents. So the best kind of agents to go to actually is like a brokerage agent, one that sells lots of different types of insurances, so they're not stuck with one brand or one company, so that way they can get you the best deal for what you need.
We recommend that if you consider changing your whole life policy to a term policy, that you make sure that coverage is full and in effect before changing your policies or canceling the other one, and or that you make sure that you are worthy of the other
coverage.
policy.
Like you don't have any like standing medical issues or stuff like that that will make you not be able to be insurable.
Right, because there's some situations where if you have a whole life policy and you have a lot of things going on, that you just might be stuck with that.
Yeah. So that's one of those things you can talk to us one-on-one in one of our coaching sessions, and we can dive into your personal specifics on that. So then there's term insurance. Okay, so term insurance is for a term, right? So a period of time. So 10, 15, 20, 25 years, that kind of thing. And it's not for your whole life. It's only for those times. So it's like, if I die within the next 10 years, I'm going to pay X, Y, and Z amount, and this is what's going to get paid out to my family because I want to be able to, replace my income if I die in the next 10 years because I still have young kids, blah, 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 right? So that's something that we need to think about, especially at our age.
Yep. So let's say you're 30 or you're 40 or 30 or 40. Let's say you retire at 65, right? You want to take around a 30 or 25 year term of policy to be taken out so that you get to retirement age, and once you're there, you can self-insure.
Right.
But when it comes to figure amounts, you're going to want to take with 10 to 12 times your income out against yourself. So in this example, we say if you make $60,000 a year and you'd want to take out a policy of $600,000 to $720,000 a year. I mean, a year. I'm sorry. Payout.
Policy, yeah.
Yep.
So I know that actually seems like a lot of money, but you're thinking about how long it'll take somebody to recover, especially if your spouse is a stay-at-home spouse. Like, they are not working. That's going to help them pay off their house if the house isn't paid off of. It's going to help put some kids in school maybe, but it's going to help them live until they are able to build up an income that can replace yours, possibly.
Yep.
Another thing is, if your spouse or your partner is a stay-at-home partner, then they also need insurance. It's not like, oh, well, they stay at home, they don't need any life insurance.
Right.
They are an economic value to sustain your life. So they're bringing home about $40,000
worth of things going on. If they stayed in the home and they took care of all, like, cooking, cleaning, all that stuff,
right.
That's generally, we recommend you take a policy out of $250,000 on them.
So
and keep in mind that when you're taking these policies out, the event of death is not, the insurance policy is not taxable.
Okay. And then we're going to move into homeowners. Okay. First of all, before we go into homeowners insurance, if you don't have a policy, get something. Even if it's not how much you can, like, let's say you can't afford a $720,000 policy right now. Get something. Get enough to at least cover burial expenses, which is typically about $15,000. So if you can get at least a $15,000 policy, and it's a term policy until you can afford to up your policy, do that. Because something is literally better than nothing. You don't want to just, unfortunately, just die and have nothing there to help with anything.
Yeah. 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 You need something. We're talking a few bucks here and there. It's for term, we're talking like $50 to $75 a month. That $75 a month is on the high end of, like, I'm getting up there in age. It's $50 is like, I'm kind of young and I don't have any health problems. So we're in that margin, right? Where you're probably paying just as much to insure something else in your home already.
Yeah. Your car insurance should be less than that.
Yeah. Well, depending on
relatively.
Yeah.
Okay, so let's go into homeowners and renters insurance. Okay, so this is your largest monetary asset. Okay, like if you own a home, but if you don't, if you're renting, that is also where all of your stuff is. Okay, so there's a couple different kinds of policy for homeowners, and this was kind of the easiest part for me. So, actually, we had to learn the hard way. Okay, so I'm gonna tell you a story. So when I was a kid, probably about 19 or so. Our house got broken into, and all of our stuff, not all of our stuff, but a lot of stuff was stolen. And so my mom had a policy. She took it out. She made a claim with our insurance, and she found out that it wasn't replacement cost. It was what the value is of today. So like all the stuff that we had depreciated in value, and we could hardly replace any of the stuff that was gone. We could only replace like maybe a third of the stuff because it was not replacement value, which sucked. So if you get a policy for your homeowner's insurance, make sure that it's going to cover to replace the value of the item when it's brand new, not the depreciation value.
Especially your home. So when we think about this, like the home we're in now was built in 2005, but some people actually live in like a lot older homes, depending on the area you're in. Sometimes you don't have a whole lot of choices in buying an older home, right? Like in Virginia, there was homes built in 1920, right? Or like there's sometimes you don't have like a whole lot of choice. So when older homes generate value over years, sometimes people home insurance is very set and forget, right? I haven't looked at this policy since we got in this house 2.5 years ago. I need to, right? But I definitely know it has a coverage clause above the value it's currently assessed at. But if you have it in a long time, let's say 5 or 10 years, you need to make sure that your house value increasing is still covered, because most of the time they'll only insure you at the rate of which you took the policy out at in that time. And it sometimes doesn't cover the rebuild cost to its full fruition in terms of if it was a $300,000 house to build in 1990, but today would cost $500,000 because of inflation, right? So you gotta make sure those things are kind of in there when you're looking at homeowners insurance, and they don't really tell you those things up front. They just kind of tell you this is how much you're covered for, this is what's covered, your roof, etc., all this stuff. And it's a lot of people don't look into those things, and it creeps up on them.
Very confusing because they don't tell you those things, which is why we are here to help you, guide you on this path to find the right insurance for you. Okay. Now the next insurance we're going to talk about, renter's insurance.
Yep.
So if you are a renter in your house, you need to have renter's insurance on your personal property, right? So like let's say we're renting this house and the whole house catches on fire. I don't have to worry about paying for this house. I don't own this thing. But I do have to worry about all of my stuff. So I want to make sure that I have a policy in place that will replace all of my things, my personal belongings, if they got destroyed in a fire or a flood or whatever.
Right. It is not the homeowners, if you're renting, it's not the homeowner's liability of your stuff within inside their facility.
In fact, it's illegal. They cannot insure your stuff in their facility. So make sure you have renter's insurance on your stuff. Okay. So auto insurance. Let's see. So auto insurance, varies state by state, and it's based on whatever rules the government sets on state, right?
Yeah, so make sure you're educated on what your state's minimum policies are and their breakdowns for liability and full coverage, depending on if you have a loan or don't have a loan on your vehicle currently.
So, as you can see, it says most people have a 100, 300, 100 policy. Okay, so that's basically saying, if I get in an accident, I have $100,000 allocated for bodily injury. I have $300,000 for bodily injury per accident, and $100,000 for damage to private property.
And that's pretty good insurance. Don't get us wrong. But when we come to auto insurance, the number one thing that we teach, and the number one thing that's helped us out over the long run, is keeping your policy deductible very high. Normally we ask, or we tell people, or we consult with people to have it set at their emergency fund limit. So if we say, hey, you have $1,000 emergency fund, we also want you to have $1,000 deductible, because that will keep the premiums low,
right,
and your coverage high. So you'll be able to be insured against a lot more damage and liability. You protect yourself so you can gain wealth, and you'll be able to not pay out as much each month.
Because you're transferring risk, right?
Yeah.
If I have a $1,000 deductible, I'm saying I am willing to take on $1,000 of this risk.
Right.
And the insurance company's like, okay, that's cool. You're splitting this risk with me. I appreciate you. I will give you a lower policy for that.
And so you want to go in there and you want to bump up your liability coverage the most you can, the most your insurance company will let you. Because some people go as far as USAA can insure up to $2 million policies on cars and just liability. Liability is the cheapest insurance you can purchase on yourself, and is the greatest return on investment.
Explain what liability is real quick.
Like in terms of
Liability insurance.
So in this case, like liabilities is your entire encompassing, like damage to private property, damage to the liability of a vehicle, damage to a person. Think people. Let's say you had 25. Say, I'm gonna give you an example. A friend of mine had his wife got into a fender bender in a grocery store parking lot. And that person, because we live in Las Vegas, Las Vegas is like, people like to sue people in Las Vegas.
Mm-hmm.
Yep. So that person came after them for $50,000 damages and liability. So they said they had medical stuff, they said they had some car damage, but it was a 5 mile per hour fender bender in a parking lot. And so he had $25,000 in liability coverage. So he had the minimum amounts you could possibly have in your insurance in the state. And so he had to come out of pocket $25,000 because he decided that he didn't take enough liability out. So those are the things, kind of things where you have to kind of weigh it out. So no one is, unless you crash into a Bugatti or you crash into someone's private estate, you're not gonna no one's gonna come after you for $1 million, and it protects. Yeah, unless you're in a really bad situation. So. Yeah, that's the best thing you can do for yourself to protect your assets. Some people go as far as they have house, and then they have car, and they have these policies, and then they decide to build an umbrella policy on top of it, and that's roughly $200 to $300 a year for another $1 million tacked onto that.
That covers both assets
Correct.
At the same time. So that umbrella. Okay. So now we've covered auto. If you got any questions, just type them in the thing so we can answer your auto questions.
And there's a lot of information going on right now.
Yeah.
So we can answer any kind of question that's going on.
So you can earn money.
Sorry, we're looking at questions.
Rosalind, if you're still there, can you please reword your question because we don't understand. I'm sorry. What does the umbrella cover again? Okay, so an umbrella coverage is like saying, I've maxed out
my home, and I've maxed out my liability on my car, and I need to take out, or I want to take out, another policy to cover both of my assets or any liability I have above it. You can go take. So I don't know. So normally brokerage companies give you umbrella policies.
Let me just break it down. Let's say I've got $1 million house, so I've got $1 million policy on that. I've got a Bugatti, so I've got a $2 million policy on that. But I need more because my Bugatti is worth $3 million. So I get an umbrella policy to cover both of my assets to cover another extra $5 million. So now I've got $8 million in coverage for either one. Does that make sense?
And those are for minuscule amounts of money for rate of return. So $300 to cover another $1 million, $2 million is very great in terms of give and take here.
Depending on your assets, of course. Okay. So now we're going to go into health insurance. So, as you guys all know about like Obamacare and all that other stuff, we're not talking about that. We're talking about health insurance that is provided by your job, typically. Okay, so health insurance. And it's almost never provided as a free benefit. It's something that you have to opt into.
Yep. Even, I guess, just in the military is probably the only place I've heard of that probably gives out free health care. But, I mean, even then you're giving up
your life,
I guess.
Yeah, I mean, it's not free.
Debate what free truly is, I guess. But we're going to go over a few health insurance policies and what you should look for in terms of these things to protect yourself and others. We're looking at the comments again. Hold on.
It would be it would be multiple payments.
Yep. It would be different policies and different payments. So in health, that was the umbrella policy, and we're going back to health. In health insurance, so you want to make sure that when you're taking out a policy, you always want to increase the stop loss, which is the amount you'll pay out, and you never want to reduce the maximum payout of them, the insurance policy holders, to pay to you.
So this is kind of like your deductible, right? Your stop loss is thinking deductible auto. It's like, this is how much I'm willing to take this much risk on myself for my health insurance. That's kind of the same theory there with the stop loss. So you want to increase that so that way you can get less
payout.
Payout, yeah.
And you never want to reduce the amount they're going to pay you in this clause. Normally we talk about PPO, which is a preferred provider organization. So basically, you've probably all heard of it, but in the military it's called TRICARE. It's kind of their own PPO, just for this example, to hit it close to home. Basically, it's a group of providers that are heavily discounted, so that if you maintain providers within a certain organization, they can provide you healthcare for very little cost. So like if I were to go to a non-urgent care within the outside of the TRICARE prime region of the West, I might be billed. Right. It's the same way if you didn't go to these 5 or 10 different doctors within inside this network, you might be billed heavier, or you might not be even covered at all. Those are the kind of things you want to look for. And HMOs is a health maintenance organization. It provides discounts the same way, but it is not as much or as many. To help facilitate these policies, we recommend most people to take out a health savings account. They're tax sheltered, and they basically they work so that you can pay your high deductibles on your insurance policies.
So a health savings account is basically you put money in it, and you have a cap. It's
tax sheltered.
Yeah, you talk about with your employer how much you want to pay into it. So that way it's already there when you need money to help with your deductible, to help with whatever other medical expenses you have. Which is kind of cool. Yeah. And like you said, it's tax shelter, so I don't have to worry about
anyone taking money from it. You can you can defer your money into it. No one's going to touch it, and the government's not going to touch it. You're going to be able to facilitate your own payment of medical without the government being completely involved in all of your money and finances. And as soon as you see the word tax sheltered, you want to make sure those things are fully you want to take advantage of tax shelter, whether it be 401ks, IRAs, with the Roth, anything that's tax sheltered, ESAs, education savings accounts, you're gonna want to take advantage of to prevent the government taking taxes from you.
Okay, so now the next thing we're going to talk about is disability insurance. Because at the age of 30, you're 12 times more likely to become disabled than to die before 65. So disability is a big thing in America. It's legit a big thing. People get injured at work all the time. People get hurt just crossing the street. Getting disabled is very, unfortunately, very, very likely. So you want to make sure that you have disability insurance. So short-term disability normally comes with your employer, especially after you've been there for over a year. And they've got FMLA and stuff like that. But we're talking about long-term disability that will pay you long-term, forever.
So when it comes to long-term disability, you want to make sure that you purchase enough, right? You want to purchase that enough and a big enough insurance policy that it covers 60% of your income, right, over the span of your rest of your lifetime. A lot of people don't take advantage of this early enough because they think, oh, I'm young, I'm never going to get injured, etc., etc. But these things are definitely things you want to take into account. And you also want to take into account how risky your job is, right, when it comes to disability. If you're sitting at a desk, sure, you can become disabled. There's lots of things that people don't take into account, like family histories and whether or not, different things run in their family. But chances are you're not going to get hurt if you're sitting on a computer all day. If you're working construction, that may be a lot different. But when this kind of goes into something where I wanted to touch on, but we're going to talk about insurances you want to avoid, and some companies try to pitch to you different insurances that if you work in high risk things like construction and things like that, they're going to try to pitch you a bunch of bogus insurances, and we're going to get into that in a little bit. But the number one thing you want to look at when it comes to long-term disability is the payout period of time.
Yes.
So we recommend having 3 to 6 months emergency funds,
Right.
and this is one of the reasons why we do it, is because the payout time after you make your claim with long-term disability can range, depending on the policy you take out, between 30 and 720 days before you receive your first payment.
Do you know how long that is?
3 years?
Yeah.
So imagine, you just got your arms cut off in a tractor. I don't know. Something happened and you had a freak accident and you're no longer able to work, right? And you have to wait 3 years before you receive 65% of your paycheck.
Which is ridiculous.
Yeah.
So you're sitting there waiting on like ramen noodles for years because you have no income.
Yep.
Because you were hurt at work.
Yep.
Short-term disability will run out by then. All your leave will run out by then. Your PTO, all that. So you'll be sitting on your butt just waiting.
Yep.
Okay.
I think that's it for disability. I think that's kind of the key topics. There's another one. If you have a specific trade skill, if you have a specific...
if you're a doctor,
if you're a runner, or you're like a
singer,
something
or
special, you want to make sure you get own occupation insurance.
Everybody's special.
Let's say you're a runner and your legs got cut off, right? There's some, you would never be able to perform your duty that you're trained for or educated for ever again. Right. So there's a different policy for those kinds of people. If you're a singer and you lose your voice and you have something damage you drink some hot coffee from McDonald's because it doesn't say it's hot, and you no longer can sing again, then you have to make sure you get this policy.
Okay. So the next one is long-term care insurance. Okay. So you need to talk to your parents if they are over 60, and if you are over 60, you need this. Like, happy birthday, you're 60, here's some long-term care insurance. 60
is the day you want to take this out. Not a day before,
no.
Not a day after, because then the rates are going to be crazy, right? But the day you turn 60, you want to give yourself a birthday gift, and it's long-term care, because that is going to help you have peace of mind. It's going to help your family make sure they're going to let them know that you have a plan.
Right. So it was really awkward because both my parents were here for my daughter's birthday, and I was like, hey guys, I know you guys were born in the 50s, but do you have long-term care insurance? Not that I don't want to take care of you for the rest of your lives, but I'd rather not.
Yeah.
So my dad was like, yeah, I got the VA. And my mom was like, yes, I have it through my job. And I was like, thank you, Jesus. So it was good to hear that they have thought about those things, because I didn't even really know about it until maybe a year and a half ago.
So if you don't know what long-term care is, it basically allows you to have insurance for assisted living or nursing homes and things like that.
Hospice care.
Coming into your house or something like that in the later years of life.
And this is like a supplement to Medicaid and Medicare, because I feel like our generation might not be able to access some of those things because the funding might be gone. So even though we're both VA veterans, I would rather not go to a VA hospital and get long-term care if I don't have to. I would rather it be somewhere nice where I can pick kind of the place with my long-term care insurance.
And the kicker with it is that it becomes very, very every 5-year increment. The older you get, the more and more expensive it becomes. And so 60 is the prime age. If you buy it before 60, chances are nothing's going to happen to you fast enough to get a good return on investment. 60 is the prime age because normally you get a great return on investment. You'll get your policy pretty low, and your monthly bill will stay the same. But if you wait, it's going to be pretty high, and you'll get your return on investment, but your rates are going to be pretty enormous.
If you're wavering in health as you're younger, maybe it might be something to consider when you're younger. But typically, a typical 60 able-bodied person you won't need it until you're almost 60. Okay. Then lastly, for insurances, let's talk about identity theft insurance. Okay, so
this one's pretty new on the billet.
Yeah. And so you think identity theft insurance, that sounds like a scam. Anyway, it did to me anyways, because I was like, nope, not getting that. Then I
The
realized
identity theft is gonna steal my identity.
then I realized it takes like 600 hours of you on the phone with creditors, with the big three, Experian,
Experian. Yeah. Experian, TransUnion, Equifax, all of them.
all of them, talking to them over and over and over, trying to get your name cleared from some jerk that took your credit card when you went to go get gas. So when
or your check or something like that.
yeah, or I put a check in the mail and they stole my checking account number. So that's something you really need because you don't have time to deal with all those things, and that's what they'll do. It's not going to tell you like you've been affected, but once it does happen, it kicks into gear and it's like, all right, let's nip this in the bud. Was this you? Was this not you? Okay, we got it. We'll take care of it for you. So that's kind of very important.
Now, the rate is about 12 million people annually get affected by ID theft, but it's going up every year because of cyber crimes and things like that. So you want to protect yourself and you want to protect others.
Yeah, so it helps clean up the mess after someone takes a credit card in your name. 600 hours, guys. 600 hours.
I don't even know what that is in days. I think that's
too many.
a long time.
Too
if
many.
you worked 8 hours a day, it'd be a long time.
Yeah. Yeah.
So next, we want to talk about insurances you should avoid.
Things that are kind of scammy, things that you don't actually need.
Things that they kind of like word is if you should have it, but you don't. And they look at you funny like, why don't you have this? But it's really just a bundle. It's like fear-mongering wording.
Yeah. Okay. So, credit, life, disability insurance.
Right. So anything that tries to be too many things at once. So we're talking about life insurance in this example, but it's trying to be disability and credit and it's too many things at once. We do not recommend you get credit, life, disability insurance.
If it's overly confusing, avoid it. Or just call us and we'll walk you through why it's a scam. Cancer insurance.
Your medical insurance will already cover you in the event of cancer. You do not need a separate policy for just cancer. I know cancer is prevalent in most people in terms of rates in America, but cancer insurance is just a buzzword for you to purchase insurance.
Scam. Alright. The next one you should avoid is accidental death.
Yeah, like I was saying with construction site companies and things like that, they try to
That's what your life insurance is for.
Yeah, that's what your life insurance is for in case you die. You don't need a separate policy just in case you die accidentally.
Your insurance are going to cover you.
Yeah.
Because both deaths are accidental. Okay.
Prepaid burial expenses. That's not really an insurance, but people say that people always talk about how they're proud that they prepaid their burial and that their family doesn't have to worry about the expenses. But the kicker is that most of these companies that do prepaid burial expenses are kind of shady in nature.
And
right?
This is not like buying a plot in advance. That's not what this is. This is like taking care of. I picked out my casket and my flowers and all that whole deal. Prepaid burial. That's kind of creepy, anyways.
Normally, it costs more because it's hard to estimate that in advance.
Right.
Also, normally those companies go out of business because of their shady ethics, but previous to the person dying.
Right. So just all around stay. I don't know. If you buy a plot, buy a plot.
Yeah.
But that's fine. That's not what we're talking about. We're talking about like full-on burial expenses. Okay.
Mortgage life insurance. Like I said before, you're doing too many things at once. You do not want your mortgage and your life insurance tied together. It's not going to work out.
No. Then credit monitoring. Okay, I'm not going to lie. I've been a sucker of this for a very long time. But it just shows me what my credit is.
You can get that for free.
Every month. I know you can get it for free. I don't know why I got sucked into it as a young kid. But it doesn't do anything. It just tells you what's going on. So if something does happen, like if somebody does take a credit card out of my name,
about
it does nothing. It's just like, hey, look, you took out another credit card. And I would either be like, I know, or, oh no. But if I had the insurance would already kick in and be like, what? Or another thing you can do to avoid this happening is to freeze your credit. Because let's be real, we've already cut up our credit cards, right? So we don't need any more credit. Just freeze your credit, and nobody can get access to your credit unless you go and make that initial step to all of the credit unions and say, yes, I need my credit open. So just freeze it and you're good. And then what else? Oh, pet insurance?
No.
No.
No. So it's just a pet, right? We have a pet that costs a ton of money.
Line item in our budget.
Yeah.
Monthly.
Literally, probably spent 1/10 of my emergency fund on my dog last month, and that was a lot of money, right? And we loathe it, right? Right.
We love spending money on our pet.
our dog goes to a dog dermatologist.
Which is insane, right? Let's
I
just talk
think
about
I've
that for a
spent
second.
more on my dog's health than my health, and that bothers me as I'm hitting the table. Pet insurance is not something you need. You never actually hit the deductible. The
No.
premiums are always super high. We've
Yeah.
had it on 2 pets at the same time, and we've tried to fund a lot of things. We don't know how expensive it is trying to go to Japan with a dog. We just say, please avoid pet insurance for all costs.
Or pets. No, I'm
The average person spends $7,000 a year on their pet. So
including food.
yeah. So just put that aside. But we recommend against it, and we say please save a separate emergency fund for your animals because they will get hurt and they will do silly things and they will cost you money.
Yes.
So
Or sinking fund or whatever you want to call it.
yes.
So that's kind of what we do. We have a special Lucy account, a Lucy line item that gets saved every month because she's kind of ridiculous.
Our other dog is fine. He doesn't
Yeah.
do much.
And then, what other insurances they avoid? I think that should be
I
it.
think that's it.
Yeah.
That's it.
Man, so that was a lot of information,
Yeah,
right?
hopefully that was really information packed and helpful for you guys.
So this week, I just want you guys to look at just your life insurance. Take a look at your life insurance and figure out, is it enough? Do I have it? Like, do I have a policy? Is it enough? Is it term or is it whole life? And what are my rates? Should I go shopping around? Just take a look at your life insurance. Like, all the rest of them are great and important, but that one I think is the most important. So
Very-
just look
yeah.
at that one this week.
The most important, like she said. If we want to make sure that if you do go to somebody, you want to make sure that you go to a proper agent. We are not
Yes.
insurance agents. We're not trying
No.
to sell you on insurance.
No.
We're not trying to take any commissions here.
Nope.
We're just trying to inform you on the amount of insurance you should have. But it's up to you to provide or to go to the right kind of like insurance people. A lot of them out there are shady. We use a company called Xander. So if you want to look that up, we can do that. But we're not endorsing them by any means.
No.
But they are an umbrella policy, and you can look at different rates.
And they're
at the same
brokers,
time, yeah.
so they've used different places. They want to get you the best rates for what your situation is.
Yeah.
So
But you can go through USA. You can look at all those different ones
yeah.
and determine for yourself
Also,
what
your
that looks
job
like.
typically has one, but it's typically not that great.
Yeah. So check it out.
Yeah. So that's all we have for you today.
Oh, we also don't recommend that you take out life insurance through your
Job.
because your job will not always be there with you. So if you do decide to depart your job before you
Die.
end that term, right? Then you'll be out in the streets with no insurance,
Yeah.
and you'll forget about it, and you'll die, and your policy won't exist. So
Yeah.
we recommend that you take a policy outside of your job.
Absolutely. So
That's it for today, guys.
have a good night. Happy Monday.
Bye.